Good afternoon. Mr. Bowler, I presume you said earlier to my colleague Anne-Marie Morris that you look at productivity and value for taxpayers' money across Whitehall. I just wonder whether you've looked at the impact of civil service working from home across Whitehall, and particularly in some of the areas like driving licences, passport office, and perhaps even in the Treasury, on the impact on productivity and therefore value for money.
I'm not aware that we've done that study explicitly. We, as my colleague Kat Little set out earlier, we have very significant reviews underway for both efficiency in terms of savings, in terms of some of the lower priority spending, but also in terms of productivity and public sector productivity. In that, I'm not alive to calculations on going right down to that specifics.
It would be very helpful to know, because you mentioned earlier that the civil service have come under some criticism, and you consider unfairly, but there is a concern, particularly in constituency mailbags, about the impossibility of getting a driver's licence, a passport renewal and so on. And of course that does, right across Whitehall, productivity has been impacted by working from home, so that would be very helpful, thank you. Moving on, in response to questions from my colleague Dame Angela Eagle, you mentioned that there is a review of regulation of energy companies. Is it the thinking that they may be required to have capital in the same way that banks do? Is that where the direction of travel is?
Well, you should probably direct that question to Ofgem, who are doing the review. But my understanding is that at the minute there is no capitalisation requirement, and there is a degree of capital we think they need to have. This is so that they can post counterparty risk forward purchasing their gas supply. So the combination of thinking about their capitalisation requirement and thinking about their obligations to forward purchase gas, it's currently 6 months out, they have to purchase the gas they need for their customers.
Yeah.
It's a new measure. Is intended to avoid this problem. But my understanding is that Ofgem will be setting out shortly their thoughts on the level of capitalisation required and what would be an appropriate level to do that.
But they will therefore be marking their own homework.
Bearing in mind that a very high level of capitalisation would impose significant costs on energy bill payers, because capital has a cost to it. So
yes, but so does massive failures.
Yes,
and I mean, this is a broken system, isn't it? I mean, will the Treasury be involved in providing advice to Ofgem, who have clearly failed to regulate successfully? Will you be providing advice, and would your advice be to regulate them like banks, requiring capital?
Well, firstly, we work very closely with Ofgem, who I think have had an incredibly challenging year responding to these problems, so I think they deserve some credit for the response they have launched. I think when you say bank-like, I don't quite know what that would mean. But clearly
requiring capital so that in the event of a rise in energy prices that they don't get
We are
bust.
looking at whether there is a requirement for a level of capitalisation that was absent from some of the very thinly capitalised companies that enter the market. All that said, we have effectively forced a level of capitalisation, because currently you have to buy in advance your gas supply. So that is already that's already been taken into account.
It's worth saying that when we're answering these questions, Ofgem is I guess it's an arm's length body of bays.
Yes.
And the Treasury has a overarching view on all these issues, including wanting efficiency and anything that's going to be a challenge to growth in the economy. So as Phil is answering your questions, he's doing that through several steps removed.
And I fully appreciate that, but having been a minister in Treasury and a minister in energy, bays, I do know very well how it works, and unfortunately this has fallen through the gaps. This is a massive failure. It's costing people a fortune at a time where energy prices have already absolutely rocketed. And so what I'm asking you is your view on how are you going to force Ofgem to fix this. But again, perhaps that's something that will evolve over time. But I don't think it's a complicated question.
No.
Will you require capital like banks have to have, i.e., in the event that they have losses due to their own trading, which might be buying forward financial instruments, not oil. But nevertheless, the banks are required to keep capital against their own losses, and at the moment, energy companies aren't. Is it something the Treasury might require them to do?
Well, that is a proposal which is being actively considered by Ofgem, and just to reassure you,
Right.
we talk all the time to Ofgem and BEIS about the situation, but there isn't any gap between us. We want a resilient, well-regulated sector, and we recognise there have been very significant regulatory failings in the last year.
Good, thank you. Moving on then, in the OBR's forecast, they are anticipating a 12 pence increase in a litre of fuel next April. 12p increase in fuel duty from next April, which is quite significant at a time where evidently wholesale prices are coming down, but the price at the pump isn't. What is the Treasury's view on forecasting for something that in the last 12 years hasn't happened? Is that sensible forecasting policy? And what do you do about the 6 billion black hole that creates in the event that fuel duty is frozen again?
Well, I might ask my colleague Beth Russell to come in on that.
Shall I come in on this? Yeah. Basically, the forecast here is done in this way traditionally. So it's a long-standing assumption that fuel duty increases by inflation, and that is then only changed when the government makes a decision about what the policy will be, which, as the Chancellor has said, hasn't yet been taken for next spring. Obviously, we as Treasury officials will be advising on the issues around that, including the costs and the wider economic and other impacts. And we would look at how to fund the cost of that alongside other measures in
yes,
in
but
the next.
Ms Russell, I completely understand that. I totally understand there are choices, and these are political choices, and the Treasury ministers haven't decided yet. But doesn't it make a nonsense of forecasting? In effect, you've got 6 billion in there that you may or may not have, and the last 12 years suggests you won't have it. Therefore, doesn't it make a mockery of the forecast?
Well, it's the approach taken across taxes.
But you've got a 12-year track record.
Yeah, and as you say, fuel duty has been in a particular position. Obviously, if it would be a ministerial decision to change that assumption for the longer term, and there would be a permanent cost to doing that at a time that they decided to do it. But that is not the position at the moment. The position is that the default is an RPI increase.
Okay, well, I mean, I would assert that it makes a mockery of forecasting.
I think you make a reasonable point, and I think that's why the Chancellor's been on the record saying what his expectations are going forward. There are sort of swings and roundabouts in the whole system. So to take some of the examples you've been given on fuel duty, there is an expectation through that it will be indexed the next year. On the conversation we're having about energy, there's nothing in the forecast that suggests some of the funding will come back to the taxpayer, and that's because I think the OBR in particular just takes the policy that they have in front of them on the day and puts it out and won't speculate as to future policy. I'm not blaming the OBR for that.
No, understood. They can only do what's in front of them.
They can only do what's in front of them.
But nevertheless, the question still remains, is that a good way to go about forecasting? Wouldn't it be better to have a review of this and decide what, on balance, maybe you show two figures, one with, one without, but you'll have been aware of the huge sort of furor about the expectation that was in that forecast for fuel duty that the Chancellor had to write to us to make very clear was simply a non-decision as yet, but it's very misleading. Anyway, I'll leave it there. It's been reported that several large offshore oil and gas firms are planning to reduce their investment in North Sea projects in a response to the increase to the energy windfall tax. Are you concerned about this? Have you made allowances for that in terms of forecasting for future investment?
Shall I come on this again? So obviously it's reasonably early days with this, and we are monitoring carefully what is happening. There's lots of dialogue with the industry. Indeed, the Chancellor met representatives of the industry on on Friday. I mean, what ministers have been trying to do with this policy is get the balance right between taxing extraordinary return, taxing the windfalls while still maintaining incentives for investment. That's why there is a generous investment allowance in the tax. The OBR have said that they don't expect there to be an impact on investment of the two windfall taxes, but we are not being complacent. We are monitoring and keeping that under review and talking to the industry.
So you are talking to the industry about their plans?
Yeah.
And what would you say is the reaction in terms of investment intentions?
So, I mean, obviously it's a new tax, and industry doesn't necessarily react favourably to that. But as I say, our existing assessment of the impact on investment is that it's not going to be significant. But we will keep talking and looking at what actually happens.
Okay, thank you. Moving on, if I may, to the FSMA bill. What was it, Mr. Bowler, that led to the eventual dropping of the proposed intervention or call-in power for the Treasury?
So I think ministers took the view that the powers in the bill were sufficient. So the bill is a very significant move to devolve regulation to our regulators, having come out of the European Union, and I think ministers took the view that quite a number of checks and balances and accountabilities in the bill, including the opportunity for the government to instruct it to review a rule if it so wishes, were sufficient. But I think the government did say it will keep that under review. So.
And it also did, I believe, give itself some amendments that would enable the Treasury to require the regulators to publish information at any time on requested matters. Is that an alternative? Is that?
No, I don't think that's an alternative to the what was going to be the intervention power. The intervention power was going to be used in exceptional circumstances to intervene. I think the amendments of the last week are in particular for the regulators to publish performance data. So, for example, how quickly they are doing the things they are doing, and be more transparent as we set up this regime.
Okay, thank you. And then quickly on Solvency II, what potential do we think that Solvency II has on increasing London's competitiveness? Do we think that could be very attractive for UK PLC?
Yes, I hope it is attractive. The main driver in the balance we struck in Solvency II was to allow those firms to be able to invest in some slightly more liquid assets. Those are the assets in terms of infrastructure and which are going to be key to net zero. We were, in terms of giving you a number, the industry themselves have talked about that loosening up £100 billion of investment. So hugely
do you think that will
significant.
come to the UK?
Yes, they are talking about that being
Invested in the
investment for the UK. I mean, it is worth very much stressing that this was done in conjunction with very carefully plotting what the regulatory regime would be going forward, which includes a mixture of both a rules-based approach and the supervisory approach of the PRA.
So do you anticipate more money invested in UK infrastructure projects? Is that the ambition?
Yes, I think the industry themselves have said they expect this to unlock more than £100 billion for investment in long-term productive assets.
Good, good. And then final question from me. Ring fencing was a key post-financial crisis reform, and only brought in around 2014-15. Why has the Treasury got such a short memory?
So I think it's really important. So ring fencing remains, continues, and the announcements on on Friday do not get rid of ring fencing. The announcements set out on Friday were part of a measured and evidence-based approach informed by a review by Keith Skeoch, which talks about addressing some of the unintended consequences of the original approach and some of the scope. So the changes are to both, and they've been welcomed by industry and regulators alike. But it's not that does not end ring fencing.
But does it risk a sort of two-tier system where smaller businesses can get away with it and bigger businesses can't?
I don't think the changes announced on Friday do that. I think the changes announced on Friday were in two things. One, representing that things move on and recognising where we are. But as we did that, as I said, that was on the case of very careful evidence base and conjunction. And then the changes announced on Friday are also part of a very large body of work, which the Treasury is at the heart of, in moving regulation that had been done at a European level into the UK, and the way we're going to do that is essentially through our independent regulating strategy. So that's the focus of those, not trying to differentiate.
But ring fencing was a UK invention.
It is, yeah.
An EU
No,
invention.
ring fencing was
so,
UK.
Yeah, so it's not part of a kind of post-Brexit change.
No,
it is
we've
decided that we got it wrong, or it was too tight, or so. But is it a pro-competitiveness measure? And if so, does it also increase financial stability risks or not?
Well, I mean, if anything, some of the changes are about consumer competition to benefit consumers rather than the whole size of things. So that we increased the retail deposit threshold to allow more competition for consumers. But the focus of the wider change in the ring fencing was essentially to look at addressing some of the unintended consequences of the former regime. So, for example, allowing banks to provide more corporate services and support financial advisors where they couldn't do that before. And as I said, because I think you make a very good point about the lessons from the past and the very large consequences. We've done this incredibly carefully on informed by independent reviews and the evidence base, and the ring fencing remains very much in place.